Hi, and welcome to the latest monthly update from Zurich Life. I'm Jacqueline. I'm joined today by our Head of Investment Solutions at Zurich, Ian Slattery. Good morning, Ian.
Good morning, Jacqueline.
So, financial markets have seen a flurry of headlines on the trade front recently, and today we are going to be discussing what has happened in the markets up to Friday, the 8th of May, how this has affected the different asset classes, and what this might mean for you as an investor. We're also going to talk about Zurich investments outlook in the short term and our recent positioning in relation to the Zurich funds. So today I'm going to be addressing some of the latest frequently asked questions in a rapid fire round. So if you're ready, we'll begin.
Great.
So to start, the markets seem to have stabilized recently. Does this mean that there's less uncertainty, or have the markets simply adjusted to this ongoing uncertainty?
Yeah, it's a great question. It's probably a bit of both. So we are obviously all very au fait with different trade tariff terms and things like that, particularly since the so-called Liberation Day at the start of April. Some of that has subsided, and then, as I've said already, some of that was just markets coming to terms with it. So just to bring this to life a little bit, what I'm showing you here in the beige line is government bonds, and in the blue line is world equities. So the two mainstay asset classes of any multi-asset investment. You can see that big drop about 3/4 of the way through the graph in relation to the 2nd of April. A lot of volatility since then. And whilst markets are still very much in negative territory from an equity perspective for 2025, they're very much off their lows. So I think it's fair to say there has been some progress made on the trade tariff front, albeit not exactly 100% clarity at this stage.
So on that topic of the tariffs and regarding the recent trade tensions, do you believe that we're experiencing a temporary phase, or is this more likely to be a structural shift in the market?
So if I again answer maybe a bit of both. So firstly, I think it is temporary in terms of the uncertainty can't last in perpetuity. And what I mean by that is there will be clarity at some point. However, the view at Zurich is it's worth paying close attention and providing credence to the fact that the Trump administration, the US administration, is quite strong on some of their philosophies and their ideology in relation to the trade tariffs. So there is uncertainty from a tactical or a short-term perspective, but some of the ideas they're talking about could impact global markets structurally into the months and years ahead. And I think an important point on that, I've mentioned uncertainty a couple of times there, is just showing US consumer sentiment and how it has suffered. So we've broken this into three parts: those who identify as Democrats in the blue, Republicans in the red, and then the overall is the blue shaded area. And I think just the one point to note is how all three of those lines have moved downwards in recent months, including the red Republican line. So I think it is important that if we do see a resolution on the trade tariff front, it should feed in positively to sentiment. However, the longer there's uncertainty and ambiguity, we could continue to see sentiment suffer.
Okay, and we've seen inflation in the US continue to trend downward, but can we expect this trend to continue in this way, to continue trending downward?
Yeah, so we have seen inflation very much off its highs of a couple of years ago. But I think it's important to note this idea of the last mile of inflation is the stickiest. So a busy enough chart here, but if I focus on the red dotted line, you can see the US inflation has come down significantly from 2021 and 2022, and it's getting closer to that kind of fabled 2% level, but it's not quite there just yet. We're seeing services inflation particularly sticky. And that's one of the main reasons we've seen, if I turn your attention to the solid red line, we did see it come down a little bit throughout 2024, but it's held steady. And that's the Federal Reserve holding steady with US interest rates in the last couple of months. And indeed, the uncertainty from the trade tariff negotiations and the announcements probably keeps them on pause a little bit as well. They've adopted a bit of a wait and see approach to not only inflation, but also to employment data.
And speaking of the Federal Reserve, the latest FOMC meeting where the voting members opted to maintain interest rates, were there any signs from that meeting that the Federal Reserve might resume cutting interest rates shortly?
So they're walking a tight tightrope, if I could say that. It's quite hard for them at the moment, as I'm sure it always is. But if you just always, I suppose, think back to the dual mandate of the Federal Reserve, it's to keep price stability. So to you and I, that's inflation under control. And also they have an employment mandate as well. So both of them are trending okay, but we haven't seen a huge movement for better or for worse in either of those main two metrics in the last couple of months. So I do think the trajectory of interest rates is still lower at some point in 2025, but the timing of that next move lower or leg lower is a little bit unclear at this time.
Okay, and we did recently create an infographic on monetary policy, and it is very interesting, all the different inputs into determining monetary policy. If you as an investor are interested in it, you can speak to your financial broker to get a copy. But one of the key questions that we've been asked in light of the recent market volatility and the changing dynamics is, can investors capitalize on this?
Yeah, so I think it just stop sharing for a moment on that one. Is I think there's always going to be opportunities, and we'll talk about the idea of active investment management in a little while. And volatility, whilst not necessarily welcome, it does provide opportunities for active investment managers. So I think that question can be answered in a couple of ways depending on your perspective. So I think for an end customer or client, I think sticking with their plan, staying invested in their fund is usually the best place to be. And if there's a change in their personal circumstances, have a chat with your financial advisor or financial broker, because most likely your investment manager, particularly in multi-asset funds, there's a couple of proverbial levers they can pull under the surface to help avail of those opportunities. So I do think for most people, if your fund is at the right risk level with the right asset class exposure, stick with it. And your investment managers, such as us here at Zurich, will be doing our best under the surface within that fund to avail of the opportunities.
And speaking of your investment manager and multi-asset funds, an asset class within that would be equities. And from a sector perspective, certain sectors have been more affected by policy uncertainties than others. So which sectors have shown strong growth and which ones have faced significant challenges recently?
Yeah, so I just bring up to the end of last week, there's 11 major sectors underlying the global stock market, and we have them here color-coded, and you can see the percentages as well. That's the performance of them year to date for 2025. You'll see on the right-hand side some of the darlings of the market in recent years, the likes of technology, consumer discretionary, communication services to a lesser extent have been the so-called losers in 2025. Whilst on the left-hand side, the couple of, or the three sectors in positive territory will be deemed to be much more defensive. So a little less exposed to some of the trade tariff narrative that we've seen, more likely to be stable, mature companies as well. But I think it's really important when you look at it, even in a year when a lot of people assume almost everything is negative or having a bit of a tough time, you still see a fairly large spread between utilities up 2.5% and consumer discretionary down more than 14%. So just as we spoke about volatility at an asset class level, there's also volatility or divergence in returns at an individual sector level as well.
And at an asset class level, no asset class has been untouched by the recent uncertainties, including the fixed income markets, which have seen notable fluctuations. So what is our current outlook for bonds?
So yeah, when we talk about bonds, we mainly think of two subsets of bonds. So it's Eurozone government bonds and then Eurozone corporate bonds or credit. So as you said, it's been no asset classes unscathed, put it that way, in recent months. But we tend to see bonds on the government side much more influenced by the prospects for inflation, interest rates and economic growth. Whilst on the corporate side, you see some more company-specific issues. So corporate bonds, particularly those that are more longer maturity, they come under a little bit more pressure in times of uncertainty. Whilst on the government side, we're seeing shorter dated bonds react a little bit better around the inflation story. So similar to the narrative we said at asset classes and at an equity sector level, lots of divergence under the surface for bonds at the moment. And us as an active investment manager, we do favor shorter maturity bonds, or those with less time to run in terms of their maturity than those are more longer dated at the moment.
Do the recent fluctuations in the bond market challenge the traditional view of bonds as a safe haven in volatile times, in your opinion?
I don't think so. So I think the concept, I suppose, of bonds over time being a diversifier. I think just to bring us back to the first chart here, you can see while still in negative territory, there's certainly uh, less or lower correlation between equities and bonds in times of stress. So I think the beauty of multi-asset funds is that you're never 100% invested in the asset class that's doing worse. Also, on the other hand, you're never quite in the best asset class the whole time. The idea of being across lots of asset classes, doing different things at different times, is you get a much smoother journey as an investor, and you're more likely to stick with your plan through tougher times as well. So, I mean, to answer it directly, we still very much see the value of bonds as a diversifier and indeed as a return asset class in their own right.
And moving to commodities and currencies, we've received numerous questions about the movements, particularly around gold, oil, the US dollar. What's been happening in these areas?
Yeah, so for us within our active asset allocation fund and indeed our wider Prisma fund range, we can allocate to certain commodities and alternatives such as gold or oil or copper, as we've mentioned. Very much a similar story of a lot of divergence. I'm showing you the chart of gold year to date, up about 16% in euro terms. So again, we can talk about the currency in a moment as well. And indeed, gold is actually down a couple of percent since its high. So similar to what we said about bonds a little bit, gold has very much been that safe haven, that diversifier so far in 2025, and indeed it was in 2024. Just to name check two other commodities, we see the price of oil down 20% year to date, and we see copper pretty much flat year to date as well. So a huge divergence in what we've seen in a bucket of alternatives as well. But they're all distinct investments, and we allocate actively. We can go up and down in those different asset classes. But I mean, even though it's off its highs and there has been volatility, gold has been a good diversifier and a place to be as a multi-asset investor in 2025.
Okay. And the investment landscape is constantly evolving, as I think you've gone into in a lot of detail in the last 10 minutes. And when you invest with Zurich, we have an expert team in the dealing room. They're based in Blackrock in Dublin, who are actively managing funds in respect to the market developments. Can you talk a little bit about Zurich's current positioning and asset allocation in light of everything that we've spoken about in the last 10 minutes?
Yeah, sure. So just to bring through a couple of key points here is, so when people invest in a multi-asset fund, there's going to be a range of equity. So for example, if I took Prisma 4, you could be as low as 30% in equities and up as high as 60%. And each fund has its own respective range. So at the moment, we're at the middle of equity ranges across our multi-asset funds. So using that Prisma 4 example at about 45%. As we've mentioned already within fixed income, a bit of a preference for shorter maturity bonds. That's both on the government and the corporate side. Whilst gold has had a very good run, we have reduced our gold exposure a little bit recently because we think maybe in the short term it won't do quite as well if sentiment starts to improve. But I think overall, equity markets are experiencing volatility. And look, it's fair to say that the trade tariff announcements and the negotiations we're going to see between the US and the UK, the US and China, the US and the Eurozone, it will be the dominant theme in the upcoming weeks. So look, in conclusion, on our positioning, neutral risk assets, again, namely equities, but very much keeping an open mind and an open perspective on our next move. We have a very consistent process that's been in place for almost 40 years, and we have flexibility within those parameters to make a move as we see fit.
Each month, we look at a key chart that highlights an important trend or insight in the world of investing, and this is to help you make informed decisions. So this month's chart focuses on the US dollar weakening significantly against the euro. So let's take a closer look at the numbers and what this means for Irish investors. Ian, would you mind going through this chart for us, please?
Yeah, so this is the investment chart of the month, which we publish on our website and indeed on social media as well. I appreciate it looks a bit busy, but I think if I focus on the left-hand side to begin with and the dotted beige line, as that line goes up, you see the amount of US dollars it takes to buy a euro go from about 104 at the start of the year up to 112, 113. So or 115 almost. So if we're going on holidays to the US, that means we get more dollar for a euro But if we're invested overseas and in the US stock market, we get less euro back as that comes across the other way across the Atlantic. So as this chart moves upwards, it doesn't help our returns as euro and indeed Irish investors. And just to bear that out a little bit, you can see the lighter blue and the darker blue lines. Both of them are in negative territory. And if I take the light blue one first, that's the US stock market in US dollars, down about 5% year to date. Whilst if I look at the US stock market in euro terms in the darker blue line, it's down much more. So they're the exact same companies. The big difference and the most important difference there is one's pricing those assets in US dollars, one's pricing them in euro. So you can see the negative effect the weakening US dollar has had for Irish and indeed euro investors in US assets. So it's something we do look at as an investment manager, and indeed currency fluctuations can work both for you at times and indeed against you, as they have in 2025.
Okay, so moving to a segment where we talk more generally about investing. In this segment, we aim to break down some of the common terminology that you might come across in the investment landscape, making it easier for both new and experienced investors to navigate the financial markets with confidence. This month, we're shining a spotlight on the term active investment. Ian, can you talk to us about what this term means and give us a little bit more context?
Yeah, so as investors, we are active investment managers here at Zurich. And what that means is we don't just buy the market. We don't just settle for the average return. We try to outperform. And we have a very strong long-term track record of outperformance from an investment perspective. And indeed, just to bring you through our process very, very quickly, for us, where we are in the economic cycle is a big determinant of what different asset classes that we want to be in. And we actively choose whether we want to be in bonds or equities or commodities or cash or property based on things like inflation, things like interest rates, things like economic growth. So where we are in that economic cycle helps inform our views as active investment managers. And indeed, as an active investment manager, we're a top-down manager. So we move from that economic cycle through to assets, different regions, different sectors, down to individual stocks and bonds and holdings that we can invest in. And we're making active decisions at each of these particular levels. So it's not just whether we want to be in, say, equities over bonds. It's also whether we want to be in technology companies more than financial companies, right down to what technology companies we want to be in, more or less, versus the entire overall investment universe. So for us, active investment is very much part of our DNA. It's part of what we do, I suppose, in terms of our active top-down investment process. And it's something that we've been bringing to life since the late 1980s here in our BlackRock office.
Right, so the market is quite dynamic. It's good to have an active investment manager who's looking after your portfolio. And I think it's something that it really differentiates Zurich Investments. Thanks, Ian. That brings us to the end. And thanks everyone who is listening to us today. We hope you found this investment update insightful. And as always, for more information on the Zurich fund range or to catch up with our latest investment news, visit zurich.ie.